Hey everyone! Today, we're diving deep into a classic chart pattern that can be a real game changer, the 3-drive. Think of it as an early warning system that a trend might be running out of gas. It's a super powerful formation for spotting major market reversals, so let's get right into it.
You know, it's the million-dollar question for every trader, right? How do you know when a market's about to turn on a dime? Well, there's no crystal ball, obviously, but some patterns give us some seriously good clues. The 3-drive is one of the best because it shows you the psychology of a market that's just tired. It's like it's given 3 last pushes, and now it's just exhausted.
So here's our game plan for today. We're going to start with the basics, where this pattern even comes from. Then we'll dissect it piece by piece. After that, we get to the fun part, how to actually spot it on a chart, how to trade it, and finally, the crucial rules you need to know to do it right.
Okay, first up, let's talk about why this is such a powerful reversal pattern. To really get the 3-drive, you have to know its history. I mean, this thing didn't just appear out of thin air. It's literally built on the foundations of over 100 years of market analysis.
The story really begins way back with Charles Dow, the guy who pretty much invented the idea of using charts to predict the market. Then R.N. Elliott came along and gave us his famous Elliott wave principle, the idea that markets move in these predictable, repeating cycles. The 3-drive pattern we use today is basically the next evolution. It takes those wave concepts and adds a layer of math with Fibonacci ratios to make it way more precise.
So, what exactly makes up a 3-drive? Let's pop the hood and look at the anatomy of this pattern.
At its heart, the 3-drive model is really just a pattern of 3 clear, consecutive pushes in one direction. Picture 3 waves trying to get higher and higher on a beach. Each of these drives is followed by a little pullback, what we call a retracement, before the next push begins. Now, for a pattern to be a true 3-drive, it has to check 3 boxes. These are non-negotiable. First, you need those 3 distinct peaks or valleys. Second, the math has to work. The pullbacks and the new pushes need to line up with key Fibonacci levels. And third, you're looking for symmetry. The best patterns have drives that are pretty similar in both how long they take and how far the price moves.
So what's the trade-off here? Well, the good news is, when all the pieces fit perfectly, this pattern is incredibly reliable for calling a reversal. But here's the catch. It takes a really trained eye to spot it correctly. It's not a beginner's pattern, and you won't see picture-perfect examples on every single chart you look at. Okay, enough theory. Let's get practical. How do you actually hunt for one of these things on a real live chart?
It really boils down to a simple 3-step process. First, just visually, you scan for something that looks like 3 distinct pushes. Step 2, you pull out your Fibonacci tools. Every charting platform has them, and you start measuring those waves. And finally, step 3, you just confirm that there's some decent symmetry going on between the drives. All right, the first magic number you're looking for is 61.8%. After that first big push, you want to see the pullback stop right around this level. This number isn't just random, it's the golden ratio. For traders, it's a huge clue. Seeing a retracement hit that 61.8% mark is your first big hint that a real 3-drive pattern might be setting up.
Okay, next up is 127.2%. After the pullback, we want to know where the next drive is going to end. A really common target is the 127.2% extension of that pullback. It's like the market is telling you, hey, I'm still pushing, but here's about where I'm aiming. It gives you a specific price level to watch.
And another major level to watch is 161.8%, which is kind of the golden ratio's bigger cousin. When a drive stretches all the way to this point, it often signals that the move is getting super extended and might be ready to snap back. See, these numbers, the 61.8, the 127.2, and the 161.8, they provide the hidden structure. They turn what looks like a random shape into a measurable, high-probability setup.
So spotting the pattern is one thing, but making money from it? That's the whole point, right? So let's talk about how to actually build a trading plan around the 3-drive.
Here's the basic framework. Your entry is absolutely key. You do not jump the gun. You have to wait for that 3rd drive to finish and for the price to actually start turning around. Your stop loss, your safety net, goes just a little bit past the top or bottom of that 3rd drive. And for your take profit, you can aim for previous support or resistance levels. Simple as that. And please, please do not forget this. No matter how perfect a pattern looks, risk management is everything. Most pros risk only 1 to 2% of their account on any single trade. Seriously, that discipline is what separates the people who last in this business from those who don't. All right, we're in the home stretch.
Let's cover the essential rules for trading this pattern, because just finding the pattern isn't enough. Success comes from the discipline you use when you trade it.
I love this quote from the source material because it is just pure, unfiltered truth. The 3-drive is an amazing tool, but it should never, ever be the only reason you take a trade. It's just one piece of a much bigger puzzle.
The whole point here is to build a complete strategy. That means you always look for confirmation from other indicators like the RSI or MACD. It means you backtest it to see how it's worked in the past. You have to know what the overall market is doing too. And most importantly, you have to master your own psychology. You need to be able to stick to your plan when your emotions are screaming at you to do something else.
So, what's the big takeaway here? The 3-drive pattern is not a magic wand. It's a professional tool. And like any pro tool, it takes skill to use it right. It works best when you get confirmation, and it absolutely demands the discipline to manage your risk.
Which brings us to our final question. And honestly, it's the most important one. It's one thing to see a pattern on a chart. It's something else entirely to build a solid, repeatable trading plan around it. So I'll leave you with this. Now that you know what to look for, how are you going to take this knowledge and build a disciplined strategy that works for you?